All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market is 195 points off of its overnight low here, and still well off of its close from Friday. So definitely an interesting start to the week. And if we go back and just take a look since the Trump tweet when the market was up here above 3,000. The market is significantly lower than what it was there, but it's been a pretty stabilizing day here. For the markets, we've seen volumes come off. They're heavy, right? They're definitely heavy, but we've seen them come off a little bit. We're seeing some bounces in some places. Other places, no, not at all. And it's a very normal type of post panic type of day here today for the markets, and one where we have the majority of stocks are up. But you look in the market, the S&P, it's up 32 points. And you go, well, okay, market up 32 points. Most of these stocks better be green. Well, most are, but it's less than 80%. Sitting in the green. There are plenty of red out there. And even though the market's sitting near highs, you can kind of tell by this graphic, most stocks aren't sitting at their highs. Most stocks are quite a bit off of their highs. So, just a very, type of action that we tend to see on this type of, day, post panic. One that, frankly, I don't make a ton out of, in terms of, hey, this defines a stock, or, the next thing is here, or this defines some of its fundamentals or anything like that. But you can kind of define some short-term trade setups. This morning, this morning for me, afternoon for others. I was talking with my brother who trades, and he doesn't trade all the time, but when the markets go into chaos, then he trades. He hates flat markets. He absolutely hates like what we saw in July, and he starts seeing the market go like that, and he just kind of goes, call me in a couple weeks, and I'll look at trading again. But with the market kind of going haywire, I think we were up all night last night, looking and watching things globally. It was just, fascinating. But we're out there, we're looking at different stocks, different setups that are out there. And one that really caught his eye was Boeing, and I couldn't argue against it very much. And he went out and bought Boeing calls. I did not. I did not go buy Boeing calls, and he's up a little bit on the calls. If you take a look at some of the metrics here, we do have some positive divergence in some of the momentum indicators here for Boeing. But Boeing gapped up, sold off here, back down to 330, and has kind of been pushing up a little bit higher here. And he went out and made the trade, bought some weeklies on Boeing. And I made the comment to him. I said, I do think the market in the ultra short run, here this afternoon and tomorrow, path of least resistance is probably higher. And there are some stocks that are tempting to me. But I said to him, I'm not sure that I could buy a call and actually make money on it. And he chuckled. He goes, yeah, that's what I'm worried about. And you always think, hey, you know what? Stock goes up, well, the option's going to go up, right? Or stock goes down, the option is going to go down. And most of the time, for calls, that is the case. But when we get a panic element that comes in, where you get a big pop in the VIX, then you get a big drop. And when that big drop happens, yes, stocks go higher. But option values can be very very dicey to play, because if you are playing your calls and you are right and the stock goes up, you're going to make money from the delta, but you're going to lose money from the Vega, which is, one of the option Greeks, the volatility number associated there. And you may have noticed that with a lot of option prices out there, they're a little bit more expensive than they've been here in a while. But, you take a look at something like a Bank of America, and we go into like next week's the 28 calls, right? And we just pull these in, and I'm going to chart what the pricing has been. But, here we are. Bank of America 28 calls yesterday were going for just slightly more than what they're going for now. At the close, Bank of America calls were more expensive than they are at the moment. In fact, if I zoom in, we could see exactly how much that is. But at the close yesterday, the last tick, the last trade happened at 69 cents. Right? These Bank of America options, and this is at the money, were 69 cents. The stock is up 10 cents here today, right? The option, the last trade, was what? 66 cents. Right? So a 10 cent rally, which for Bank of America is what? 0.3%. And the option's weaker. You look and you go, well, if Bank of America were up big, well, the option will be up. And you're absolutely right. You're spot on. You're absolutely right. But that's what you need, right? If you're going to buy calls, you need to be right. You need to be right soon, and you need to be right big. Because the downside, if you're wrong, is that you lose implied volatility and you lose direction. And that can go that can go into much deeper much deeper option losses than what is seen in a typical market. And that's the risk when volatility, increases this way. When volatility increases like this, I do like to kind of, keep my eye out for some put opportunities and say, okay, you know what, I'm gonna go with the side where the IV is going to go in my favor if I'm right. That said, it's not one that I'm out there buying puts aggressively on this bounce. I don't think this is enough yet to convince me that the bounce is over or that a little more upside can't come into play before the next drop out there. But that's something to keep in mind. And so if you're going out and you're taking a look at something like a Caterpillar, right, which is actually down a little bit today, so you'd expect your option to be down. And this isn't as actively traded, but you can see from yesterday, the option was 420 and now it's 320. You go, wait a minute. Caterpillar stock is only down 68 cents. It's only down 0.5% to go from 620 to 320. That's kind of drastic, right? That's pretty extreme, and you're right, it is extreme, because yes, the stock has gone down today, but implied volatility on the options has also gone down here today, and has sucked some value out of the options, and so the cost to just be holding it is very expensive, and that's the added risk of a market like this is flat. Flat always has a time premium associated with it, but flat now has a time and an implied volatility premium, and two premiums that are very expensive there with it. How do you get around it? You can do spreads. You can get deeper into the money, but then you're putting more cash at risk. For me, when I see an opportunity that I like, right? In fact, this is what my brother did. He liked Boeing, and I didn't go out and make it, but he did. He bought a weekly. And he went out of the money, right? And he came, sizably out of the money, and he said, "Look, I'm putting what I'm willing to risk on it, and if it goes against me, all right, fine. Next it'll expire." Whatever, because he only put what he's willing to risk. He didn't put on a full normal position. And if it goes his favor, it can pop pretty good. Obviously, it's not going to have the return that a normal position would have if it went in his favor, but he doesn't have to worry about the added risk factors there to it. So That's one way to kind of navigate through some of this market. And I know that when we look at the market, it's always about, hey, are things going up, or are they going down? But for option traders, it's not always about that, right? Yes, those things come into play, and those are major factors. But there are times in the market where, from an option standpoint, we have to understand the added implications that the market puts into our options. And we're seeing a lot of that IV sucked out today, but we're not seeing it sucked out to a point where a whole lot more can't get sucked out. So it's a very interesting moment right here for the market. I would not be surprised to see a little more upside in the short run, just looking at things. But ultimately, I need to see the metrics change before I'm willing to go out and kind of go out and say, all right, it's time to buy aggressively here with it. Now for the challenge, there's nothing there. There's no crossovers. Vulcan Materials had a downside 3-7 crossover earlier today. It's not holding, right? And even if it had a downside crossover, it wouldn't be a signal. We have a downside crossover in UPS, which isn't a signal. We have a downside crossover in Chipotle, which isn't a signal. And then no upside crossovers. In fact, if we come in, I'll just pull up the scan and show you. This is just for the challenge watch list, but zero upside crossover. So it means I go into the close here today with cash again. Not a position I love, but position that is what the challenge dictates here at the at this moment. I was asked today if I could step in and override the algorithm and go make a trade for the challenge, and my answer was yes, I could. I've given myself the out for that, the availability for that. With number 10, I can go outside and say, hey, right now the market is a little bit of an unusual circumstance. That said, there's not a setup I love. There's not a setup where I just go, man, this is just too juicy to resist. I've got to go and grab this or I'm missing out big. There just isn't one. Visa perhaps, but looking at the option value and everything else, it's just not, it's just not worth it for me to do, right here. If there was a situation or setup that I absolutely loved, then yes, I would. We have some gains. We can go do that, without, making or breaking the challenge. I would be willing to do that, but it's not something I'm going to, press into. It is something where, if there's a great opportunity, I'll go do it. And if there's not, then, I most certainly won't. And, if it's not a challenge signal that I'm trading, I will definitely, explain that and show that, hey, this is not a challenge signal that I am trading. But, obviously I would much prefer to have the signal and wait for the signal and run and get in on the, on the signals as they come in. Okay. All right, I want to go out and break down the market vibe here with you. It's one where I don't know what today's reading is yet, but it is something where we saw it turn bearish earlier this week, and there's some major factors with it. I suspect it's not moving a whole lot today, right? A couple reasons, and as we go and we look at the market internals here over the next 10 minutes, you keep in mind, the market is up right here. The market is up. The S&P futures are up nearly 50 points. That means the S&P is up 37 points, 38 points, somewhere around there. One of the bigger up days of the year today, okay? One of the bigger up days of the year. Yet today, the bullish percent index is actually moving lower. That's, you don't see that very often. A lot of times when, we've kind of hit some bottoms, we'll see a big bounce in the bullish percent index. We saw it at the end of May, at the beginning of June. We saw, sizable improvement in the bullish percent index. Well, we don't see that happening today, right? But bullish percent index is only one factor, right? If we come in and we look at, let's just take a look at our sectors, right? let's see what's running. Here's tech on top. With communication services, tech, consumer discretionary, industrials. Right, those are who we want to see on top. Utilities, consumer staples, they're smack dab in the middle. Similar performance there. Energy and materials, square on the bottom here with it. So it's a decent stack, right? It's a decent stack intraday. It's not something we look at and go, man, this is overwhelmingly bearish. But if you look at the 1 week stack, right? Utilities on top, real estate, healthcare, staples, 4 of the top 5 in communications, you could call a more conservative group, but even those are down. This is a market that the only thing holding up is utilities and real estate. Everything else is strongly red over the course of the last week. This is a very bearish 1 week sector flow. If we come into a 1 month sector flow, we also see a very bearish sector flow. And keep in mind, over the last month we have seen, some gains out there in various groups, but real estate, utility, consumer staples is still a very bearish sector flow. Today's kind of mildly bullish sector flow is not changing some of the longer term type of dynamics. 3 month real estate, utility, consumer staples, all 3 on top. This continues to be a very conservative, very bearish sector flow, for the market. Now, again, in and of itself, it can, sometimes we see this and the market zooms higher, right? It is just one piece of the puzzle, right? Sometimes we see the bullish percent index continue to go down and the market zooms higher. It's just one piece. But as we look at all the different pieces, we're going to notice kind of a very similar, element to them, to where they're all kind of showing something similar. Number of stocks making new highs versus new lows. Right. This is an indicator that to me suggests what? It suggests that we will see new highs come into the market. The number of stocks hitting new highs that we saw in June and July was significantly greater than we've seen in a while. And typically, when that happens, there can be a correction, there can be a pullback, but then we'll see a move back to new highs on the market. The selling over the last couple days hasn't done anything in terms of creating something dramatic from a new lows standpoint, right? If we look back here in September and October, November, December, dramatic new lows, right? With many, many stocks hitting brand new lows compared to stocks hitting brand new highs. We're not in that. And this is still in a very, semi-bullish, neutral type of position. And I only say neutral because it's below zero, but it has not made any of its big stretches downward that would suggest, hey, you know what, this is a chaos event that's going to get a lot worse sooner than later, right? So, a little bit of a different view, but, this does go into the market vibe, and it's, one of the reasons we don't see the market vibe sitting at minus 10 or something, super extreme. If we look at the advancers versus decliners, right? The advancers versus decliners here, yesterday we got to minus 2,400, right? When the market gets down to minus 2,400, it's almost always followed by a bounce day or 2 or 3. To have some strong bounce is typical, but it's also typical that another low comes into the market. Right, so it's kind of we're seeing the bounce come into the market today, and obviously this would suggest we may have a little bit more of a short-term bounce in it. But how often do you see the advanced decline ratio get down to this level and not be followed by more kind of strong selling or sell pressure types of days? Not very often. Right, not very often. If we start to look at metrics and how they're performing relative to each other. So, for example, small caps versus large caps. This is one. Let's just come in here. I'll pull up a performance chart. There we go, if I get my fingers on that correctly. But if we look at small caps versus large caps, the performance differential, it's not more than 2%, right? It's only about 1%, where small caps are lagging large caps by about 1%. So it's not, this isn't the typical monster bearish type of performance ratio. This is a very neutral performance ratio when it comes down to it. If we look at the S&P and we compare it to things like emerging markets, right, the EEM, well, we are seeing something sizably bearish. Look at the performance differential here between the emerging markets and the S&P 500. It's a huge differential. Right, and it's a very bearish differential. And I know we're seeing U.S. equities fall, but the bigger drop has been in some of these emerging markets. And if we come in and we look at China, like the Chinese FXI, it's an even bigger differential. Over the last 30 days, China's down over 10%, while the U.S. is down 3.5%. Right? I know there's a lot of angst, consternation about what the trade war means and everything else, but there's very little doubt that the drop in trade and the increase in tariffs has a significant impact on Chinese corporations, as it does U.S. corporations. But I think some of the news that we see is very slanted to how it's affecting the U.S. companies. But this is something that you could make a really good argument has a much more dramatic effect for some of the Chinese companies. But we see that very bearish differential there. If we look at transports, right, which are mostly U.S. Let me get rid of the S here. Mostly U.S. stocks. You can see it's kind of like small caps. No real major differential here. And that's kind of what we see across the board when we compare U.S. U.S. companies. But when we start to go globally, then we see something a lot more bearish. The bottom line, volume flows are strongly bearish, but bottom line is the market metrics are bearish. They turned bearish last week, when we talked about them. There's no sign of uptick in the market metrics here today. Right, no real uptick. There's a little volume flow uptick, but we're not seeing a mass change the way we saw on Thursday. A mass change to the downside. We're not seeing that same type of mass change to the upside, here today. Doesn't mean we can't see it tomorrow. Doesn't mean we can't see it, Thursday or Friday. Those things could definitely happen. But so far as things sit, we are not seeing those come into play. Okay. Alrighty. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow morning. Take care.